Hey guys, it's Imran from Options Insight with your macro options spotlight for the 24th of March. Okay, so let's take a look at these markets. Okay, so taking a look at our dashboard, if I share the screen, but what do we see? Stocks were pretty unchanged yesterday. They got faded from that 4,000 area on the S&P. Did manage to tag that area, but that seems to be quite a strong resistance right now. KRE was down 3%, which is a regional bank sector. So obviously still some pressure on the banks there as deposits have been leaving. And it seems like, they want to really test Yellen's resolve here and kind of force the issue on some sort of deposit insurance. And the only way that's going to happen is if they tank the banks some more. Now, it does seem to be spilling over into European banks as well, which have been getting hit today. Deutsche Bank down over 10%. That's the weakest bank in Europe now that Credit Suisse has gone. And then gold exploding higher, having another little test of 2,000 as real yields tank and threaten to break below that 1% level, which they haven't for quite some time. And then finally, copper staging a bounce, whereas energy commodities were lower. Copper, even though it's industrial, has been rallying and trading much better. It's a bit weaker today, but in general, it's been trading a lot better than the likes of oil and nat gas. Vol-wise, we did see S&P catch a bit of a bid. So we saw a 2 vol pop there, but then European vols were softer, although they were obviously catching a bit of a bid on the move down today. Europe down about best part of 2%. And then gold vol really exploding, nearly 2 vols on the day, as this upside really starts to catch a bid and people are wondering if we're going to take out the highs anytime soon. And then who knows how high gold can get this year, right? I mean, some people are thinking 23 to 2,500 is potentially doable. And then if we look at carry, European carry deeply negative still, kind of similar picture to what we've been seeing. China not really managing to move as much as its implied would have you think. So carry to be harvested in China, a little bit in the US indices, but they have been winging around. But really you want to stay away from selling too much gamma in Europe right now. And then skew wise, we are seeing a bit of a bounce in skew, a vol higher in the S&P as some protection buying comes back in. And we're also seeing call demand, as we said, in gold and silver, taking those skews lower. Okay, charts wise, as we mentioned, we do think the markets are going to test the resolve of policymakers across the globe. Global banking sector is the weak spot, and they're going to go after these banks. This seems to be happening in real time. So if you look at Deutsche Bank's credit spreads, CDS spreads, they are blowing out. 5 years gone above 200 basis points. This is the highest level it's reached. And that's because the stress in the AT1 bond market, right? AT1 stands for additional tier 1 capital. Credit Suisse had a bunch of those bondholders, and about $17.5 billion worth of those bonds got wiped out to zero. They literally got less than the equity holders. So that has really got that bond market a little bit concerned, and the yields in those bond markets have exploded higher into potentially double digits. And that's going to make it hard for the banking sector to raise money in that market. And so they may be forced to issue more shares. And that's why the bank sector is down 5%, because that's what the market's kind of pricing in. And also ahead of the weekend, everyone's a bit worried that you might get more bad news over the weekend. So squaring off risk before the weekend is also going to keep things in risk off mode today, most likely. Now, tech has obviously been benefiting, as we said, from the lower rates and the rotation away from cyclicals, financials, things like that. And obviously just generally lower yields are good for tech. Now, NASDAQ, however, has failed to break above 13K. That seems to be the big resistance zone. But if it was to break above that, there could be an acceleration, because on a longer term chart, that does look like a really important level, and we could get some acceleration there. So just be on the lookout for that break. And then something a little bit not too encouraging out of Goldman's in a report that they put out, forecasting that US households are going to be a huge seller of equities potentially over the next year or two. They're forecasting 750 billion outflows of equities this year, and then 500 billion next year. And that's basically the idea being that there are viable alternatives now, like money market funds, bond funds, that are offering attractive enough returns to get investors out of equities, not wanting to take that risk anymore and park into something like fixed income. So that's going to be a headwind for equities going forward if that forecast turns out to be true. And we can see that. I mean, certainly wealthy people are looking at 5% yields and licking their lips and thinking that's not so bad for something that is, in theory, the safest risk out there. All right, moving on. Idea-wise, I've been looking at the euro. With the dollar suffering lately and not really catching a risk-off bid at all, it's been because the rates market has priced such an aggressive repricing of Fed cuts, basically, right? So by March 24, the Fed is expected to cut by about 125 basis points. It's pretty dramatic, whereas the ECB is not pricing any cuts by that time. So this huge divergence is why the euro has been so resilient. And then, last week they also did deliver a 50 bip hike and showed that they weren't budging. Now euro inflation does tend to lag US. At some point, it is likely to come down. We have already started seeing economic surprises out of Europe, disappointing relative to the US, and that's usually a bit of a leading indicator for where the euro should be headed. So we do think this spike in euro relative to the dollar is going to get faded at some point, but we're patient. It might not happen next month. It might not happen the month after, but in coming quarters, we expect euro to knee-jerk back down and reprice accordingly. So we do think that left tail in euro is being underpriced. We think buying some downside, maybe out to 6-month maturity in euro, starting to look interesting again. If we look at our volatility dashboard, we can see here that vols are kind of mid-range. Bearish risk reversals are screening here because vols aren't exactly super cheap yet, where then we'd be in buy put. So saying if you're not comfortable buying a load of Vega, personally, I don't think an 8 vol looks too bad to buy it. So 8.3 vol. And if you look at the term structure, the front end is 8, but so is the back end. So whilst the front end might come down if the market stops realizing, I kind of don't see a massive risk for 6-month Vega at 8.5 to get repriced down to 6, basically, right? And that's kind of the risk that you're taking if you're buying that Vega. So we think the skew being relatively low, we think the vols being relatively decent value. Right now, they're carrying themselves, which would make you think front end's okay to own. But for me, I'm not looking to trade the gamma of this thing. I just think the euro needs to head lower and price in the idea that Europe could be in a recession as well. There may be concerns around energy security later in the year as we head into winter. And we do think the ECB at some point is going to have to U-turn and catch up with the Fed, who's going to do the U-turn faster, right? So the Fed seems to lead central bank action all the time anyway. The market's already priced a pivot for the Fed. When are they going to start to price a pivot for the ECB? And when they do that, the euro is going to have to reprice lower. So that's what we're trying to get in front of by owning 6-month downside in euro. In terms of the exact options we'd be looking at, okay, cool. That's it for today. Thanks for listening, everyone. I'll catch you all next week.